We are covering special allocations for contributed property under Internal Revenue Code Section 704C, a critical and frequently tested topic on the Enrolled Agent Part 2 exam. The core purpose of Section 704C is to prevent the shifting of tax consequences among partners. Specifically, it deals with property that a partner contributes to a partnership when that property's fair market value is different from its adjusted tax basis. The difference is called a pre-contribution or built-in gain or loss. The absolute rule you must know for the exam is that this built-in gain or loss must be allocated back to the contributing partner when the partnership eventually sells the property. Let's walk through a classic exam scenario. Partner Alex contributes land to the Acme partnership in exchange for a 50% interest. The land has an adjusted basis of $50,000, but a fair market value of $80,000. Partner Beth contributes $80,000 in cash for the other 50% interest. The partnership takes a carryover basis of $50,000 in the land. The built-in gain is $30,000, which is the difference between the land's $80,000 fair market value and its $50,000 basis at the time of contribution. This entire $30,000 is Alex's pre-contribution gain. 2 years later, Acme Partnership sells the land for $100,000. The total recognized gain for the partnership is $50,000, calculated as the $100,000 sale price minus the $50,000 carryover basis. The exam will test your ability to allocate this gain. First, you must allocate the built-in gain. The first $30,000 of the gain, which is the pre-contribution gain, must be allocated entirely to Alex. The remaining $20,000 of gain is post-contribution appreciation. This portion is allocated according to the partnership agreement, which is 50-50. So, Alex gets $10,000 and Beth gets $10,000 of this post-contribution gain. In total, Alex's allocated gain is $40,000 and Beth's is $10,000. The most common exam trap involves something called the ceiling rule, which applies under the traditional allocation method. The ceiling rule states that the total income, gain, loss, or deduction allocated to partners for a property cannot exceed the total amount recognized by the partnership itself. Let's change our example. What if Acme sells the land for only $70,000? The partnership's total gain is $20,000, $70,000 sale price minus $50,000 basis. Alex had a pre-contribution gain of $30,000. However, because the partnership only recognized a $20,000 gain, the ceiling rule limits Alex's allocation to that $20,000. Beth, the non-contributing partner, gets allocated zero gain. This creates an economic distortion because Beth is not being made whole for her share of the economic loss. To correct this distortion, the regulations provide two other methods: the traditional method with curative allocations and the remedial method. For the EA exam, you mainly need to know that these methods exist to fix the ceiling rules problems. A curative allocation uses other partnership items to make the non-contributing partner whole. The remedial method goes a step further and actually creates notional tax items of income and deduction to ensure there is no distortion. A simple way to remember the core concept is the phrase, "What's yours is yours." The pre-contribution gain was your gain before you ever joined the partnership, so it must be allocated back to you. Always identify and isolate that built-in gain first, assign it to the contributing partner, and only then allocate the rest based on the partnership agreement. This will keep you on the right track during the exam. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.